Hello, everybody. Welcome to this weekend's edition of the Weekly Wrap. This edition is episode 9, and I've got a good one today. And it's titled A Tale of Two Markets because we're really seeing two conflicting stories here in the markets. On one hand, you have people like Cathie saying that equity markets are in a bottoming sequence, that her strategies specifically are bottoming, and that a huge bull market is to come out of this recession and this bear market. And then you have people saying that we're back in a 70s style environment, that inflation is too out of hand, too sticky, the geopolitical situation is too bad, and there is much more pain to come. And obviously both of those can't happen, so someone's got to be right and someone's got to be wrong, and I'm here to bring you both sides today, and it's going to be really great. So I'm just going to go ahead and say, if you like this type of content, be sure to subscribe here on YouTube. Be sure to follow us wherever you listen to podcasts. We release this style video every weekend, and then every day that the stock market is open, we'll release a short little video recapping that day. So let's go ahead and get into it. So Cathie Wood's claiming that stock markets are in a bottoming sequence. We have investor sentiment, technicals, the Fed suggesting that a lot more pain's to come. So where is this coming from? So we have 4 different markets really correlated with the one that we're in right now. On the bull side, 62, we had a recession, a pullback. Bear market very similar to the one we had now. There was a rally, not as significant as the rally that we saw, but a rally, and then it came back to the lows, which is kind of what we're seeing now. We're not there yet, but it had this market kind of come back to the lows, and then a bull market followed from there. And then 2015, it definitely, the percentage is not the same, but it is more correlated with what we're seeing now. So in 2015, we saw the market drop pretty heavily, like it has now, and then a rally that was even bigger than what we saw in this market, and then it retested the lows, just like up here in 1962, and we saw a continuation of a bull market. So on the bear side, obviously, you have 2008, the global financial crisis. Obviously, there are a lot of correlations now with what happened then. And in that market, it had a rally just like we did, and then another sell-off, and then the sell-off after that was just capitulation, panic, fear, running for the hills, and then we finally bottomed later on. But that would suggest that we have a lot more pain to come. And then in the 70s, which is similar because of the inflation crisis that was happening then, you had that rally just like we do today, and then sell-off, and then capitulation, and then the bottom. So we haven't really seen capitulation yet, and usually in a really bad situation, you need that to happen before a bottom in a market. But obviously with the pandemic just a few years ago, and all of the different geopolitical things, the Fed stimulating the economy and then tightening faster than it ever has, we haven't really seen a situation like this one. So I think it's going to be completely different than all these markets, but these are just good things to look to. And I'm going to say this throughout the video, but the best thing that you can do during times like this, when it's so uncertain, have we hit the bottom already? Is there going to be a way steeper drop off? The best thing to do is to just dollar cost average, honestly. If you're an investor, just be consistent. Don't even look at the news. Just set times that you're going to invest in, and then on those days, go in and invest, and don't look at the news. Don't let it scare you out of investing. Don't get FOMO. Don't go in too early. Just stick to a plan, because the people that are going to make the most money out of this situation are the people that come up with a plan and then stick to it, no matter what happens. Because if you're dollar cost averaging and you're averaging in, the market's at a discount right now, and then say it goes up, and say we retest the June lows and then we go up from there, then you've been averaging in through the bear market, and then your positions go up as you're averaging in, and it's all good. And if the market goes down and you've been averaging in already and the market goes through the June lows, then you just keep on buying. You keep on averaging in, and you get those low prices as well. And eventually the market will recover. but you will have been getting the prices the whole way down. So in my opinion, if you have a long time horizon and you're a long-term investor, just dollar cost average, find a plan, stick to it, and you'll be okay. But let's take a look at the yield curve inversions. So this is suggesting a weak economy, because when the short-term yield is higher than the long-term, then it's saying that the market is weak, the economy is weak, and the Fed's going to have to lower interest rates over the long term. And right now we're seeing the level of inversions increase to a level where a recession is extremely likely. I obviously believe we're already in a recession, that we have been for a few months now, but one thing that's interesting about this is that the Fed has never been raising rates while the economy is this weak or while we're in a recession. Usually when we have an economy like this and it's weak and the Fed steps in, it's to lower rates or ease the economy to help get us out of this bad situation. But the fact that we're seeing yield curve inversions at this level already, and the Fed is still raising rates at a level or at a rate that we've never seen before, and that they're still remaining as hawkish as they are, could suggest that the market could get a lot weaker, that the economy could get a lot weaker before it gets better. But these inversions are calling for a pivot at some point in the future, obviously not in the near future, because the Fed has not indicated that at all. But the fact that they're being hawkish while the economy is already weak could lead to some pain in the markets. But obviously, Cathie Wood was in the title of this video, and we are going to be listening to what she has to say a little bit today to bring in that bull case, at least for her style of stocks, the innovators, the disruptors. And she does not believe that we're back in a 70s environment. In fact, she believes that soon we're going to see a steep level of deflation as technology disrupts our everyday lives. So let's take a look at what she has to say here.
Now, many people believe, and certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market. Because today, the PE ratio of the S&P 500, assuming $200 for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate. The S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s is wrong.
So she's saying that the Fed's not going to be able to keep interest rates high for long, and that we're not going to see inflation like we did in the 70s, that basically the environment that we're in right now is suggesting that we could actually see deflation, and that the Fed will be able to lower interest rates to around 2%, and that the market is not really seeing that yet. So obviously that's a different point of view than a lot of investors. The general market sentiment definitely would not agree with that. Since the summer rally kind of ended, that bear market rally ended, we've seen an increasing level of bearish sentiment in the markets to the point now where it's really, really heavy bearish. And usually when you see sentiment this bad, especially among retail investors, it could suggest that the market is going to rally again, but I don't know if we're there yet, but this could be an indicator that the general market doesn't really see it that way. And whether that's a good thing or a bad thing is yet to be seen. But the general market is definitely not seeing the same things that Cathie is seeing. It's kind of seeing that the situation in Europe is very dire, that inflation's out of control, not only in the U.S., but in Europe and in other places. Obviously, there's a lot of instability with Russia and China and Taiwan. And all of that together is just, it doesn't look good for stock markets domestically or around the world. So here is a chart that outlines every bear market and recovery since 1835. So a lot of history here. And as you can see from down here, the average length of a bear market is 28 months. And the median is 18. So anywhere between 18 and 28 months is really like the average length for a bear market. And we are only like 9 months in. So we are not to that point of the average bear market. In fact, this would be an incredibly short bear market if we were bottoming right now. Now, to be fair, Cathie Wood's investments have been in a bear market for much longer than that. They've probably been in a bear market for over 18 months now. So when she says that her stocks are bottoming and creating a bottoming sequence, then she could be more correct with that. But the general market is not really there yet to the average. So that would suggest more pain to come if we saw another at least 9 months of a bear market. And then the general decline, the median is 32%, and the average is 38%. And on the S&P 500 right now, I don't even think we're at 20%. We were in June, but right now we're sitting around 18 or 19%. So that would also suggest more pain to come. And then the length of time from the peak to the trough. So that's from the peak of the market, which from what we saw was in January of this year, to the trough, which is at the lowest point after all of the pain, max pain really, is 14 to 16 months. And again, that would suggest at least 5 more months of pain to come. And then generally speaking, from the trough to a complete recovery is about a year. So in general, again, I'm just going to repeat this. It probably pays in this environment to dollar cost average and not to bet one way or the other, because we are in such a volatile market, and it really is unprecedented what we're seeing. Obviously, we can draw correlations to past markets, but it is unprecedented what we're seeing right now. And if you're a long-term investor, it's best to stick up to a plan and not get spooked. The people that are going to make the most money out of this are the people that just consistently invest and stick to their plan. And if you have a long time horizon, you will be rewarded immensely in the long term. But obviously, it can be scary right now, and I get that. I just hate when people get scared out of their plan and then don't end up making the amount of money that they could have if they just stuck to it. So if there is more pain to come in the short term, when could that come? And history tells us that September, late September specifically, is usually a time of the year where stocks could suffer. So right now, obviously, we're in the beginning of September, and it would say that usually we're flat to a little bit positive until late September, and then we could see a sell-off, and that's from 1950 to 2021. So last year, obviously, so this is the most up-to-date information. And if there is going to be more pain, especially in the near term, we could see that towards the end of the month. And that would align with midterm election cycles as well. As you can see, especially during midterm election years, you'll see that the end of September going into October is pretty bearish. And then after that, you see some recovery. So Obviously, from Cathie Wood's point of view, if we are in a bottoming sequence right now, or at least in her funds, we could see some more pain throughout the fall, and then throughout November, December, into the winter and holiday season. She could see some recovery, maybe a new bull market in the stocks that she invests in, as she would say. If you're in the more bearish camp, maybe that just means another bear market rally after some heavy pain here in the end of September into October. That's what history tells us. Obviously, we don't know till we get there, but history is telling us that in the fall, at the end of this month, going into October, we could definitely see some pain. And when you see synergies aligning with midterm election year cycles, just general September throughout the year, we're in a recession right now. When you start seeing these synergies stack up onto each other, they become more relevant to the situation. So Cathie Wood, I'm not showing all the parts of this video where she said that she sees her stocks bottoming, that all that stuff. I just didn't want to show all of it. Don't feel like getting copyrighted, and I don't feel like just having a video running for that long. So I'm just going to go ahead and sum it up. So basically, she envisions a new bull market being driven by deflation, and the reason that she thinks that deflation is going to be more prevalent than inflation in the coming years is because the rate that these new technologies are advancing. And she claims that when costs are coming down, which they are right now in her sector, that really drives deflation and disruption, and that it could drive a lot of growth as well, especially in her sector. And as she states in this video that I'm about to play, there's going to be a lot of people spooked. There already have been a lot of people spooked out of her funds that are going to run to benchmarks, and she thinks that that's a mistake. So I'm just going to let her go ahead and say it.
We're keeping at it. Technology is going to permeate every sector and will transmit some deflationary undercurrents that I think are going to be quite surprising. And I think that the kind of bull market that is going to come out of this is one that investors dreamed of in the late 90s. They dreamed of it and they acted on it, and that ended badly. Today, because of what happened back then, they're running for the hills. They're running for their benchmarks. And that, I think, will end badly as well. So, again, we're keeping at it. We're staying the course. Our research is pointing us in the right direction. It's the best research on innovation in the financial services world. And I think the resolution to this tug of war between 70s or not is going to accrue to equities' favor, and especially true growth stocks, those that have real revenue growth and are not manufacturing their earnings, the kinds of equities in our strategies.
So even she mentions there that there's this huge tug of war of, are we in a 70s style environment right now? Are we not? And she argues that her style of investments will be the ones with true growing revenues, with true costs coming down. And she takes a little jab at companies manufacturing their earnings with huge buybacks, which are most of the biggest companies in the S&P 500 right now. And a lot of people kind of envision her fund as like a new type of NASDAQ technology growth. And if you look at the chart now from the past couple of years and compare it with the dot-com bubble in the late 90s, early 2000s, they look really similar. There was a lot of excitement, hype, a lot of growth in a lot of these companies, and it kind of fell apart from a macroeconomic standpoint and just from the point that it was too early, and it crashed. The NASDAQ was down like 80% plus in the dot-com crash, 75%. And that's where her fund is at pretty much right now. But she believes that the upside to come out of this is even bigger than what happened from there, that this is going to change our lives at a faster pace than the internet did, and that her strategies are really going to lead the way out of this crisis that we're in right now. And whether that's correct or not, obviously, we'll have to see. Even she believes there's a little bit of a tug of war going on with investors right now, but I do think for me to give you the best content, I have to give you both sides, and I think that this reflects both sides a little bit better. So if we take a look at smart money versus dumb money, obviously we like to look at this a lot on the channel, and dumb money has been coming out of the market. That's the brown line here. And dumb money typically is pretty correlated with whatever the market is doing is what dumb money is doing. And we have smart money coming back in now. That the market is headed lower, and that can be a bullish signal, especially when these lines have such a big gap between them. If a lot of smart money is coming in and a lot of dumb money is leaving the market, that can be a very bullish signal. And if a lot of dumb money is coming in and a lot of smart money is going out, like right here at this peak of the summer rally, that can be a very bearish signal. So whether a bear market rally is going to come out of this or a bottom, obviously we don't know either, but we can look at this right here and say that, hey, this looks bullish, at least in the short term. And it's usually a good sign when smart money is flowing into the market. So the IPO market has dried up. So generally, when IPO listings get this low, that is near the bottom of a market. And why is that? So private companies, obviously, when they go public, they want their company to get as good of a price as it possibly can. And private companies right now are seeing markets not that they're not fairly valuing companies, but that valuations in the public market are too low for them to come in and see any sort of incentive. So that can actually be a bullish signal, because if these companies are saying that, hey, valuations are too low right now, then that can mean that there's some opportunity in the market for a general investor. And they'll come back in when the market is valuing either at a fair value or too high, like in 2020 and 2021. So it may seem bad that IPO private companies don't want to go public right now, but it actually can be a bullish signal because it's suggesting that the market is too low or that it's just undervalued. So hedge funds would disagree with Cathie Wood and with smart money even, and they're flooding into large silver positions. Now, I don't have an S&P 500 charted over this, but when silver positions have reached this level, not only do commodity levels rise, but generally when silver positions are over this dotted line, the equity markets can drop up to 20%. So this was in 2018. We had a little bit of a bear market there in 2019 and then right now. So it doesn't go that far back, this chart, unfortunately. But I just wanted to show this because a lot of large institutional investors are coming into commodities. They've been trading in a range for a long time, about 2 years. And they believe that commodities are still going to outperform and that there's a lot of pain left in the market. So while smart money kind of is coming back into the equity market a little bit, that there are institutional buyers here, and that private companies say that the market is undervalued, hedge fund managers are at least hedging their bets and saying that, hey, there could be a lot more pain to come. We're scared, and we want commodities because we think that they'll outperform in the time of pain in the equity market. So let's take a look at Cathie Wood's fund real quick here. This is her flagship fund, RK, and this is what I meant. This is kind of what the NASDAQ looked like in the late 90s and early 2000s, and obviously we know what's happened since then. And one thing that I wanted to point out, the reason that I brought it up here was, so obviously we're at $40 right now, 59 cents. The low from the COVID crash was around $35, and this is a weekly chart. So it didn't even stay there for a full week. And we've kind of just been coiling now for months on her fund, and it's extremely low. I mean, the same levels that I was at during the COVID crisis. I mean, it was higher than this even before COVID, before people really even knew about her fund. It got really popular during COVID and afterwards, obviously, because of how much it surged. But I think she got pushed down somewhat artificially by hedge funds and institutional investors. Obviously, a lot of the stocks in her fund were way overvalued up here, but her fund reached $160, and it's at $40 right now. And a lot of stocks are in the same pattern as her fund right now, kind of creating that bottom of what Cathie Wood was saying, that she believes that when she said that she believes markets are bottoming, she was really referring to this chart here. And she doesn't really see it going lower than this. And from a technical standpoint, it is hard to see it going lower than this. I mean, it hasn't been lower than this since 2017. And it didn't even get lower than this during the COVID crash. It did by a couple dollars, but it didn't even stay there for a week. So I do think that this is interesting. It's something I just wanted to show before we get into the rest of our technical analysis here, that if she is right, this fund is in deep value territory. There is immense opportunity right now in this sector of stocks. And a lot of people are really just bearish and negative on this fund. But, as Warren Buffett says, be greedy when other people are extremely fearful. And people could not be more fearful and negative on this fund. And it's not like she doesn't have research to back this up. There's a lot of research to back this up. And I just think it's something interesting to look at. So let's get into the rest of our technical analysis now. I like to start out with Apple. It's completely just fell through this trend line, so I'm going to take this off for next week. But it's finding support at the 155 level in this zone that we had mapped out from like 152 to 157. There's a lot of structure here. There's a lot of support here, as in the general market, which we'll see next. I have this kind of just bearish trend line on it now in case we come back up here in the future, because I think that that'll be something that'll be kind of like a resistance. And I do think when we break through this trend line up here, it'll correlate with the trend line that we have drawn on the S&P 500, and that'll indicate that we're kind of out of this bear market. But for now, we're going back down. Generally, when Apple surges like this and then falls, it'll fall through at least like two levels. So I could see Apple definitely coming back down to like the 140 level eventually. And that would send the S&P 500 kind of towards its June lows. And then from there, obviously, there'd be a lot of support on Apple and the general stock market. And we'd have to see what would happen from there. But yeah, right now it's looking bearish again on Apple. This leads the market. It leads the technology sector. It leads the growth sector. It's the largest company public in the world. So obviously, whatever Apple does is going to drive most of the market. But we do have some support right here. So let's take a look at the S&P 500. It's been really bearish since we rejected the 200 moving average again. And actually, this trend line glitched on my chart, so it's higher than it should be. It actually should have just touched right here. So I do apologize for that, but the trend line should be right here. But it touched the 200-day moving average and the trend line at the same spot, like right here. So it's been bearish since then. Obviously, we have a lot of structure and support here. We're at 39.24 on the S&P 500. If Apple continues to sell off, the next level for the S&P 500 would be the June lows. And then I don't want to make any assumptions from there. I'll let you know what I think if we get there, but right now, obviously, that's not where we're at, so I'm not gonna talk about that yet. But if Apple rebounds, if the market rebounds, this would be the next level. If not, we could come back down to the June lows. We really could end up in kind of this range for a while, and then this trend line will become more prevalent at the end of the year. But right now, it's really choppy in the markets. There's a lot of really important levels, and I think it's going to be hard for the S&P 500 to break one way or the other unless we really get something really bearish, like the Fed hikes interest rates by 0.75% and inflation's just like out of control. If it goes higher from the previous month, something like that could break us through these lows. But other than that, I see the market kind of going into this range from here. It's going to be difficult to break one way or the other. So lastly, let's take a look at Bitcoin. And Bitcoin's really just been in this general range for a long time now, since the middle of June. It's been a couple months. Obviously, we kind of broke out of this range, and it was looking bullish for a while. Then we came back down, coiled, and now we're just back in here. Obviously, on the channel, in my Daily Dose episodes, I've really been emphasizing the importance of the 17,500 to the 17,700 level, which is the bottom of this range right here. Because if we break through there, it really opens up 11,000 on Bitcoin, and that would be almost a 50% downturn from where we're at, and we're already down like 70% plus on Bitcoin. So obviously that would be really, really bad. It would send us back into a crypto winter, like we saw after Bitcoin first hit 20,000 for the first time in like 2018. So obviously that's going to be a really important level. I think if the S&P 500 and the NASDAQ break through their June lows, that would cause Bitcoin to kind of sell off too, unless the world starts valuing Bitcoin as like a hard asset commodity. But right now, the price action hasn't been indicating that. It's been trading more like a hypergrowth tech stock. Because the adoption isn't really there yet. We're getting there, but it's not there yet. So it's been trading more like a hypergrowth NASDAQ stock, like a Cathie Wood stock, honestly. So that's where Bitcoin's at. Obviously, it's in this range too, just like the market, but the stakes are a little bit higher for Bitcoin. Obviously, the upside is a lot higher than the market too, but it could open up a lot of losses if we break through this zone. So I'm going to stop there. Thank you for watching today. I was really happy with this episode. There's a lot of uncertainty in the markets right now, a lot of tug of war, as Cathie Wood mentioned in one of those clips that I showed. I think the best strategy for all of us is to have a long-term time horizon, to formulate a plan, to stick to it, to be consistent, and don't get spooked out of it. I think there's a lot of opportunity in this market right now. And that the people who are going to make the most money are going to be the ones that create that plan and stick to it, no matter if we end up hitting a bottom again here or if we capitulate lower. It doesn't matter. I think the best opportunity and the best growth is going to come to the people that have that plan. So thank you for watching. Be sure to tune in this week for Daily Dose episodes. Obviously, there won't be one tomorrow on Monday because the stock market is closed in the U.S., but we will pick back up on Tuesday. So be sure to tune in, subscribe if you like this content, and as always, thank you for listening.